two seminars today of the Global Sustainable Investment Alliance on the global trends in responsible investment. We have a couple of speakers. We'll take 1 hour for this seminar. And the basis of the seminar is the report that we issued last year as a Global Sustainable Investment Alliance. That is the review that we had. Basically, in all the regions of the world, there's a global trends report. Names might vary. Some people call it an SRI report, indicating the status of sustainable and responsible investment in the various parts of the world. And here you'll see the members of the Global Sustainable Investment Alliance, Eurosif, and within Europe there's also UCSIF and the VBDO from Holland. And then there is GSIA based in Hong Kong, covering the Asian part of the world, RIA for Australia, Australasia, and of course US in the United States. There are a lot more sustainable investment forums around the world. They are not represented. These are the largest sustainable investment forums in the world. And as you know, an association like Eurosif already has 9 members of the national SIFs. It's good to indicate that. The mission of the GSIA, just to tell you a couple of words, is to deepen the impact and the visibility of sustainable investment. We do not talk too much about terminology. You could talk about sustainable investment or responsible investment. But there is a kind of area where we have to say, well, what is it? What are the definitions? And that is a discussion that comes in view when you look to the several reports that are made across the globe by the Sustainable Investment Forums, and of course in our Global Sustainable Investment Review. And as you can see, the vision that we have is the world where the sustainable investment is fully integrated in the financial systems and in the investment change, and thereby of course facilitating the transformation in the economy that we need to have in view of the challenges that lie ahead of us. So, how do we move on in this webinar? You can ask the questions using the gray question mark on the right side. Those questions will be gathered. You can send them on all times. Please indicate who the question is for. Certainly at the end that's relevant because we have 3 speakers. And at the end there is a Q&A session. And so please share your questions with us and try to make it as interactive as possible. Also, this presentation will be recorded and will be available on our GSIA website, and the address you'll find on the slide in front of you. So who are we? Who are the speakers? First of all, I'll share just a couple of slides as an introduction on this global report, and again, this report also can be found on the GSIA website. Then we'll have 3 speakers. Simon O'Connor, Director of RIA, will discuss the report on Australia and New Zealand. After that, we have Lydia Guet from SRIA, covering the report from Asia, and then François Passant, the PD of Eurosif, will share the report that has been made by Eurosif last year. And like I said, after that there's time for Q&A. Now I told you that this is a session because of course global implies that you operate around the world, so we'll have this session 2 times at 5 o'clock our time. This means 8 hours from now. We'll repeat the session, but then we will, of course, also include the Americas, because by that time they will join us. Just a brief update then on the SRI states in general. This is a report that we launch every 2 years. So we compare 2014 to 2012. And what you can see, there's a tremendous growth of this market from 13 to 21 trillion dollars, but also the market share has increased from 21 to 30% of all professionally managed assets. Now, keep in mind, it's all a matter of definition. This is including, let's say, even the most light form of sustainable investment. If you, there is a slide where we have a split of these numbers of the 21 trillion over the different instruments, different forms and strategies, and then you see that the largest chunk and also the largest growth is in negative and exclusion exclusionary screening. Now keep in mind that this is all screening above what the law requires. So for instance, in our country, in the Netherlands, it is forbidden to invest in any producer or seller of cluster ammunition. Before that became legislation, we would include that amount here, this element. After the legislation came into force, of course, it is not a special screening, so we do not add that number once it is already covered by existing legislation. But still, this is a very important thing, and the market share, let's say, of 30% includes even the most light form of responsible investment, meaning that you just have one simple negative screen, one exclusion. The other remarkable thing is that ESG integration is really gaining pace, and we'll see later on how that relates to the different parts of the world. But certainly in this part, you see there's a tremendous growing. So, do we integrate the ENS criteria or ESG criteria in your mainstream selection process? And then finally, and I'm very happy to see that because I'm a very big supporter of that, we see that corporate engagement and shareholder action is used a lot, and it's of course an instrument you can use in all kind of forms. This is also an instrument you can use, for instance, with passive investing. That's, I think, all to be said on the generic report. There's a lot more to be found again, and the report is available to you on those sites, as I said. But let's now go to the three speakers, and starting with Simon O'Connor, who will brief us on the situation in Australia and New Zealand. Simon.
Thank you, Giuseppe. Thanks for that introduction, and pleased to be here and have everyone on the phone around the world this evening or this morning, wherever you are. We have just, in Australia, launched our recent and most up-to-date data on the size of the responsible investing industry in Australia and New Zealand. This was launched about a month ago and reflects data up to the end of 2014. And what we can say, and what we've been saying a lot in the press over the last month, is really that we've seen the industry really thrust into mainstream attention over the last 12 to 18 months. In Australia in particular, there has always been a very strong uptake of responsible investment, but it's been something of a sleeping giant where there's been massive high-level support for this, but really it's been under the radar somewhat. And what we've really seen in the last 18 months is it's really been thrust onto the radar, and it seems there's a lot of attention on a daily basis on ESG-related issues and investor responses to ESG-related issues, and a lot more appetite, I would say, generally amongst the large institutional investors, asset owners, superannuation funds, to use more of the tools available to them in responsible investment. And so what we're seeing as a result of that is a lot more activity and active ownership strategies being employed. And often that has run up against some quite controversial and become quite political in some examples that I'll go through. Just as an example of that, in the last about 2 years, we've seen about 30 of Australia's major super funds, superannuation funds, divest of tobacco. And this is an interesting one because what we've generally seen in terms of the dynamics of the industry over here is that the major superannuation funds tend to be have fairly large support for ESG integration, but have tended to take a position where divestment is not usually a tool that they use. So they will generally say, we own the market, they're large enough to be owning the market, and they usually choose engagement and ESG integration in its other forms. So this has represented something of a significant shift where some of the largest institutional investors in our region are starting to build up an appetite and get more comfort with the concept of selective divestment of stocks. And that has flowed out in a number of ways where we've seen in the last year and a half a number of large funds divesting selectively around certain parts of the fossil fuel production chain, and equally more recently in the last couple of weeks, in fact, a few large funds excluding a particular company as opposed to an industry on the basis of it having some fairly major allegations of human rights abuses involved in the management of asylum seekers and refugees over here. So we've seen 3 very major superannuation funds divesting of one particular company on those grounds. So it's really a big shift in the way responsible investors are enacting their duties as active owners and responsible owners of capital. This, of course, has led to quite a lot of media attention, and I think at the same time we've seen running concurrent to that is a really strong surge in the demand side in consumers who are increasingly asking questions of their investment managers and asset owners and pension funds around how they're investing those beneficiaries' savings. And so that is feeding into a lot of conversations, and that retail interest is really feeding right up through the value chain, through the institutional markets as well. So, for example, we undertook some polling about a year or so ago that indicated that, you know, a vast majority of Australians, about 70% of Australians, do expect that their superannuation, their pension, is invested responsibly and that it does no harm. And these kind of results are coming out from polling quite regularly at the moment, and it's really pushing trustees and pension funds out here to have a serious consideration as to how they take into the interests of their members and the ultimate beneficiaries in the way they allocate capital. So as you see here on this slide in front of you, that we have quite a substantial portion of the market now being invested through responsible investment strategies. The vast majority there is ESG integration, which represents 95% of the capital that we calculate in this market. Now that 629.5 billion Aussie dollars there represents about 50% of total assets under management in Australia. That ESG integration number, I'll go into some detail shortly, but we do consider that somewhat of a conservative estimate. We've put a whole lot of work into estimating that this particular year, which I'll go through in a bit of detail. And then on the other side, we have 31 billion, a much smaller portion made up of screening, positive, negative, norms-based, impact investing, and sustainability-themed investment. And although a small number there, what you'll see is that there's been some really very strong growth in the last couple of years. If we move on to the next slide, I'll just give you an insight into the New Zealand market, which also has quite a substantial proportion of the total assets under management in New Zealand managed under responsible investment strategies. This is largely driven by some of the large Crown institutions, the New Zealand Superannuation Fund, and a couple of other government-managed super funds, asset owners, who do take a fairly serious approach to responsible investment, applying negative screens, plus ESG integration, plus quite active engagement strategies. So that makes up a big portion of that. And then again, we see some movement at the smaller end of the market, the retail and the negative screening, the positive screening, and sustainability-themed investments. So if we move to the next slide, we'll see a chart here that shows the change over time over the last year of assets being managed under different responsible investment strategies. And we see some really strong growth of 25% of what we call the core responsible investment strategies. And we label it core because it's the sum of impact investing, sustainability themed, and all types of screening. And it's really just to get a handle on, right, if we wanted to look at what is our best proxy for the retail offerings, those investors selecting ethical or SRI type strategies, this is really the closest proxy we have for that. And so we track that fairly closely, and we have been tracking this for 14 years now, in fact, and we'll come to what's changing there. But that $31.6 billion there and that 24% growth, that number has actually doubled in the last 2 years. So at that end of where we're seeing the retail demand for these products, we're seeing a really significant growth there, to the extent that 2 years ago we had 4 fund managers offering SRI, specific ethical and SRI products, who are managing over $1 billion. Today we have 9 fund managers managing over $1 billion in that category alone. So really substantial. The other interesting one there is impact investing, which has really grown substantially, which is consistent with really just, it's very much an emerging theme in Australia, but we will expect to see that continue to grow. There's a lot of work going on in that space right now, quite a lot of government support for impact investment products, and we're starting to see some of the institutional investors, just recently one of the large pension funds make a very large allocation to an impact investment fund. So it's moving from something that has been more in the private wealth markets and the philanthropic space, where they have that element of the market has been dominating this area, and it's moving now into the institutional space as well. And then we see some quite interesting products emerging across all these categories here, but sustainability themed products across low carbon type funds, sustainable agriculture funds, forestry funds, green property funds and others. So there's quite a lot going on there. And with that growth is coming a lot of new products to market across all asset classes and all styles of investments. The ESG integration piece there, the nearly $600 billion, it's worth just spending a few minutes on this. One of the challenges for all of us as global sustainable investment organisations globally is really to get our heads around what does it mean to integrate ESG factors in sort of best practice or leading practice globally. How do you define leading practice in ESG integration? And this is something we've been thinking about over the last couple of years and wanting to say, well, how do we differentiate between those who state they do ESG integration and those who we know do it very deeply and really embed that in their investment decision-making process. So this year we went through a really deep and detailed process where we assessed over 80 asset managers across our region. We went through all publicly available documentation we could find on those managers. We set up a framework against which we rated those 80 managers. And what we did, we worked out on the basis of assessing all the definitions we found globally on ESG integration, we found that there are a few core pillars that are really critical for leading practice in ESG integration. Those pillars were things such as a public commitment to responsible investment, having a responsible investment policy in place, a commitment to transparency of processes and approach, and very importantly, systematic process for ESG integration, and evidence of active ownership and other stewardship practices such as voting and engagement, and being a member of a collaborative organisations in this space. So we built a framework, we balanced that and weighted that framework against policies and stated commitments versus actual evidence of process. And we rated these 80 managers, and anyone who scored over 80% in that rating is what we included in our report. So out of 75 PRI signatory asset managers in Australia, in the end that came down to 11 asset managers are included in that nearly $600 billion. So we were quite strict on where we drew the line there because we wanted to really emphasise that this is leading practice only. So there's obviously a bias towards a couple of very large fund managers who make up a big proportion of that, but pleasingly that assessment process turned up a few quite small asset managers as well. So we were really keen that methodology didn't exclude or didn't have a tendency to bias towards those who were really good at reporting this stuff, for example. And we're pleased to see asset managers across some different asset classes rating quite well, private equity, infrastructure, property, as well as equities, fixed interests. So we have a paper on that, and in the report itself we dive into that in quite some detail, and happy to share more of that. So if we move to the next slide there, and this next slide looks at consumer growth, the retail demand effectively over the last 10 years. And what we really saw is a long period there where it effectively flatlined at below 2% of total assets under management. So this is really an interesting one, is that although there's such a strong uptake of responsible investment in Australia, we see that that's largely driven by the institutional side. What we're seeing over the last couple of years is a really strong surge in the retail demand side, and this is sending reverberations through the whole investment value chain. So that has doubled in the last 2 years, and we're seeing this as a really strong driver for what I've been talking about in our country is the second wave of uptake of responsible investment, where people have made the public commitments, have been happy with that for quite a few years, but now we're really seeing the next wave where people are really deeply integrating what that means, and as I said earlier, are really have a greater appetite to use more of the tools available to them across responsible investment. So you're seeing a lot more active engagement, you're seeing more selective divestment, you're seeing allocations of new mandates such as low carbon ESG themed smart beta funds, tilting of portfolios, etc. So we're seeing the full suite, and as a result of that, in fact, ironically this report gets harder to do each year because a lot of our major pension funds and asset managers are in fact integrating multiple responsible investment strategies. So it becomes harder and harder to allocate them to just a negative screening or just an engagement or just an ESG integration, because we're seeing increasingly multiple strategies being employed, which I'm reading as a real maturing of the industry out here. So I'll wrap up at that point. Oh no, sorry, the important next slide I should go to is something we do each year, is just assessing the performance of the average responsible investment fund against the appropriate benchmark, against the mainstream funds and the ASX 300 benchmark. And you know what is really remarkable and really positive story that we find consistently each year is where you assess the Australian share funds, Australian equity funds, and the multi-sector growth funds, we see outperformance of responsible funds across the short, medium and long term. And you'll see there 1, 3, 5 and 10 years across the Australian shares and the multi-sector growth funds have outperformed, which is really quite remarkable. We see a bit more of a mixed result in the international shares, where we see some outperformance and some in between the two benchmarks, which I think sort of goes to the point that we are only human, and there are good stock pickers and bad stock pickers. But what it really says to me is it supports the increasing amount of evidence we're seeing to support the fact that the consideration of responsible investment as a core part of your investment decision-making process enhances your ability to make good investment decisions. And this data is really critical to support that. So it's very pleasing to see that again this year, the really strong outperformance of responsible investment funds. And with that, we'll conclude just, you know, the key sort of takeaways for us of this year in our regions. We're seeing strong growth of assets under management, a maturing of the industry, really strong demand, which I think is really going to grow, a continuing strong uptake out here, and very strong performance. So I'm going to now pass you on to our next speaker, who's Lydia from GSIA. Thanks, everyone.
Thank you, Simon. Before starting with an overview about the trends in Asia, I would like to give a short introduction to GSIA and AIGCC. GSIA was founded in 2001 specifically to promote sustainable finance and responsible investment across Asia. And our mission is to facilitate the transformation of Asia's financial markets towards a sustainable future. Primarily, we do this through thought leadership, capacity building, and engagement and advocacy, for example, through briefings, webinars, and workshops. We also set up the Asia Investor Group on Climate Change, AIGCC, which is specifically dedicated to create awareness among asset owners and financial institutions about the risks and opportunities associated with climate change and low carbon investing. AIGCC provides capacity for investors to share best practice, to collaborate, and also to connect across a very significant regional and international network. So looking on the next slide, we can see the key trends in Asia, I would say. So we know that Asia is a region full of contrasts, and the challenges we face are unique and really complex. So we're all aware that the need for sustainable and responsible investment is now greater than it has ever been. So it is really a critical time, but it also is an opportunity specifically for Asia's financial markets to be part of the solution. And where progress is limited in most of the markets in Asia, which are still at an early stage of development, we are seeing a steady growth in sustainable assets. And specifically, environmental, social, and governance factors are increasingly on the agenda of mainstream investors. That's very encouraging. To highlight three specifically, which is green finance initiatives that we see in China and Indonesia. And you may have heard that there have been some issuance of green bonds in Asia. So that's a clear trend that we see. The second one is that investors are much more concerned about sustainability issues, as well as the investment opportunities, for example, in clean energy and resource efficiency. And the third one is ESG integration, which is growing. So we see a widespread development on ESG-related disclosure policies. The emerging trends clearly point towards a dynamic market with significant potential. And our research identified a year-on-year increase of 22% in sustainable investment assets, except Japan, since 2011. So now they stand at $44.9 billion US. So on the next slide, we will see some emerging characteristics of sustainable investment strategies in Asia. Our 2014 Asia Sustainable Investment Review identified certain very interesting developments. For example, the most commonly adopted sustainable investment strategies in Asia are ESG integration, which stands at the moment at $23.4 billion of assets that are being managed using this strategy, and exclusion and negative screening, which is at $16.6 billion. We also see that sustainability-themed strategies are gaining momentum with a 56% growth per year since 2011. These are investments specifically dedicated to clean energy, green technology, or sustainable agriculture, for example. It may come as no surprise that the region's major financial centers, for example, Singapore, Hong Kong, or Seoul, plus Kuala Lumpur, have 90% of the reported sustainable investment assets. Specifically, Kuala Lumpur and the Malaysian government have been very actively supporting the development of Islamic funds for a number of years now. We also see that climate change is an important issue for investors, and about 72% of respondents to our survey are taking climate risks into account. And 62% say that it will be much more important in the next 2 years. Top of mind are physical risks, regulatory risks, and reputational risks. For investors, we see as key motivation certainly financial opportunity, but also smart risk management and fiduciary duty. So we see that Asia's investment landscape is changing. And in particular, ESG disclosure requirements are an important factor. Stock exchanges in Hong Kong, in Singapore, Taiwan, or Malaysia are issuing ESG disclosure guidelines. Most of them are still voluntary, but we can expect that the stock exchanges will follow the international trends and progress to comply or explain or even mandatory guidelines. And from an investor perspective, certainly clarity and certainty are key for long-term investment decision-making. So in Asia, Asian governments need to create more assertive and ambitious policy frameworks with sustainable priorities. And we already see some examples. So South Korea, for example, has been a pioneer of green growth. They established a national strategy for green growth from 2009 to 2015 and a 5-year plan in 2009 to 2013, which specifically highlight those factors. And China has actually emerged as an international frontrunner on several fronts. For example, the emission trading schemes, which will go national next year, or the recent establishment of a green finance task force to develop policy, regulatory, and market innovations that incorporate the requirements of sustainable development and green finance within China's financial system. So looking on the last slide, I just want to make some concluding remarks. We've seen that 2013 and 2014 have been important years for sustainable investment in Asia. However, the understanding of ESG risks and specifically the integration of the analysis into core investment decision making is still at an early stage. And enabling the growth of Asia's sustainable investment market very much requires more informed investors with ESG capabilities and expertise, but also a better collaboration between policymakers, regulators, and the investment industry. Lastly, a more conducive and supportive policy environment is critical. Overall, these positive trends are very encouraging, And they certainly demonstrate that the sustainable investment landscape in Asia is constantly evolving. And with that come a lot of opportunities and progress. So far from trends in Asia. And now I would like to hand over to Europe.
Thanks, Lydia. This is François Passant. Good morning, good evening, everybody, and thanks for attending this GSIA webinar. I will review with you the findings of our biannual SRI study. The last edition, the 6th edition, in fact, was published last October 2014. So the numbers relate to the end of 2013. And of course, as usual, it's always a challenge to summarize trends in 13 European markets, and therefore you will excuse that there is a lot of scratching the surface and simplification in there. Still, we want to directionally give you a good flavor for what's happening here in Europe. I'll start with a few introductory comments on methodology. First, for those who are not really familiar with the European market, you have to realize that the SRI market is not harmonized in Europe. In fact, there is not even a consensual, agreed, universal definition of what constitutes SRI here. So what we've done in the study is we've looked at the 7 processes that we deem to be part of the SRI/ESG family. I.e. approaches that take into account both the financial objectives of the investor as well as his concerns for ESG matters. Those numbers are based on an extensive survey of the industry. We have had more than 200 responses. We survey asset managers on the one side and asset owners for the part of their assets that they managed internally. Another distinction that is important to make is that we distinguish between product-specific strategies and what we call overlay strategies. And that's a very important distinction to make when you compare, for example, assets under exclusion policies with, let's say, best-in-class assets. If you can come back to, yeah, this slide. So overlay strategies are typically deployed on a wide range of assets. So for example, if you have an exclusion policy covering, say, controversial weapons on 500 billion, we would count 500 billion euros against the exclusion process. So that's just something you have to keep in mind. So the first slide illustrates a snapshot of the industry process by process. And we've omitted here impact investing, which I have a dedicated slide later on. Impact investing represents about 20 billion euros so far, but I'll come back to that. What is clear is that exclusion dominates the SRI approaches in Europe. In fact, exclusion is the most popular and most consistently applied approach across the EU. I would even say that it's going mainstream. About 40% of professionally managed assets in Europe are subject to one or more voluntary exclusion criteria. As Giuseppe said, we only count voluntary approaches, voluntary exclusions, and not those mandated by law. So that's an impressive number. Typical exclusion criteria in Europe would include controversial weapons, tobacco, alcohol, gambling, and nuclear weapons. It is followed, a second most popular strategy is ESG integration. Also, I will deep dive into this later. For the moment, we just count here under the 5 trillion all integration approaches, whether they can be labeled as loose or more systematic. That's an impressive number. It's a big growth, again, compared to the previous study, compared to the 2011 numbers. And then you've got norms-based screening, which I'll comment also, a phenomenon probably very typical to Europeans. And I just wanted also to insist on the importance of engagement and voting. So even though these practices are gravitating essentially around 2 key markets, the Netherlands and the UK, we see evidence that it's spreading over other European markets, in particular in the Nordics, and we believe that this is a good signal that more and more investors act as active shareholders around ESG issues. Of course, by definition, as I said, best-in-class assets and sustainability-themed assets are also smaller, but still not significant. Most best-in-class assets are in fact located in France, which is a historic market for this approach. but there are also some other interesting markets such as Switzerland, also in the Nordics, where there is evidence best-in-class or positive screening is also growing. And we can now move on to a more dynamic view on growth of those strategies. Imre, if you can move. Thanks. So the good news here is that between 2011 and 2013, all strategies, all approaches exhibited growth, and growth that was even surpassing the growth of the whole asset management market over the period. As you can see, the market as a whole, the asset management market in Europe grew by 22%, and all other strategies actually surpassed that percentage. That's good news. The strongest growth, that's not really a surprise, is coming from impact investing, albeit starting from a low starting base. And we started to measure impact investing assets back in 2012. So there's not a lot of depth, but very strong growth definitely there. But as you can see, double-digit growth happens everywhere, even to overlay strategies where the starting base in 2011 was already quite significant. And it's still impressive to see that exclusion, even though they were already largely adopted in 2011, have continued to grow by 91% between the 2011 and 2013. So, of course, growth is less spectacular for best-in-class, but as I said, the good news is that it's spreading into other markets outside France. Norway, Sweden, Switzerland, and the Netherlands, for example, are starting to be interesting markets for asset managers who have deployed such strategy. And thematic sustainability themed approaches are also growing fast in the Netherlands, which is the #1 market for this strategy, followed by the UK and Switzerland. Next slide. So in the next slide, we want to comment a bit on a phenomenon, an approach that I believe is quite typical of Europe. I don't think it's widespread elsewhere. It's a norms-based approach, which is basically an approach according to which you screen your investment universe according to some internationally recognized norms covering, at least in our methodology, E and S and G criteria. In fact, if you use a norm and only cover one of those dimensions, we would probably qualify this as an exclusion criteria. So to qualify under norms base, you really have to apply a broad sustainability screen, which for us equals E plus S plus G. This approach originates from Scandinavia, and Scandinavian Nordic markets are still the largest contributors in terms of assets to this strategy. But the good news is that this is also an approach that is percolating to other markets. In fact, France has become the #1 market for this strategy. This is a phenomenon we saw already happening back in 2012, 2013, where and now France represents about a third of the total norms-based assets, followed by the Netherlands and of course Sweden and Norway. The most common screens are the UN Global Compact and OECD guidelines to a lesser extent. These are the most popular say frameworks or norms deployed there. Next slide. So another interesting strategy in Europe is ESG integration, and we have a very strict definition of ESG integration. I think Simon also mentioned the fact that there are different ways to approach ESG integration. We believe that to qualify as ESG integration, you definitely have to have a policy with an explicit inclusion of ESG risk and opportunities into your traditional financial analysis and investment decision, and that this has to be based on a systematic process. So it's got to be explicit and systematic. And because the survey is self-reported, we decided last year for the first time to really try to break down the different types of practices around ESG integration. So we created 3 categories of ESG integration. The first category we call non-systematic. It's basically whenever a team produces ESG research and such research is made available to the mainstream portfolio managers. Category 2 relates to systematic consideration or inclusion of financial ratings into the valuation of company. So there's already a step into a systematic approach. And category 3 goes even further. It's a mandatory investment constraint based on ESG ratings or research when mainstream portfolio managers are constructing their portfolio. This could lead, for example, to exclude some securities or overweight, underweight some of them based on the rating, on the ESG ratings. And as you can see, when you apply such, let's say, a breakdown, we get to about 2 trillion euros in assets under systematic or mandatory ESG integration approaches. We don't yet have the historic depth, but going forward, that's the number we're going to qualify as ESG integration. This year, to keep some kind of historic comparison, we also kept in parallel the 5 trillion. And 5 trillion, as you can see, is already representing a huge growth. This can be explained probably by the fact that some people are starting to move into ESG integration. So even though the process may not be systematic yet, we still see this as a good signal for the industry that people start to step toe into considering ESG integration, even though there might not be some systematic processes around this. Most of the integration market is concentrated around the French market and the UK market. Both of these markets represent about 2/3 of the European integration assets. But growth, and that's the good news, is also happening everywhere, especially in the Nordics, which is also quite a new phenomenon because there's no historic culture of ESG integration in that region of Europe. Moving on to maybe impact investing, a few comments to conclude. As I said, we started to measure the assets under impact investing in 2011. Now, you have to remember that we are using a very specific methodology as well here. We do not count public funding, nor do we count philanthropic funding. We only focus on impact investing private assets managed by institutional investors and asset managers, so pension funds, insurance companies, and so on. These assets would be counting in there, but no philanthropic and public funding. And that actually leads to some surprising results, in fact, in terms of market breakdown. What you see on the right-hand side are estimations, let's call that estimations, of impact investing assets as we count them on a country-by-country basis. And Netherlands ranks first. This is due to a couple of large Dutch pension funds that have put quite some money into impact investment funds or mandates, followed by Switzerland. Switzerland is not really a surprise. There is, as you know, a very strong high net worth individual market, quite a few family offices and private banks over there, and traditionally this segment of, let's say, the retail market is more inclined to consider impact investing. And then there's a range of other countries between Italy, Germany, United Kingdom, Sweden, France, with smaller assets and probably different approach to impact investing as well. In fact, if we were counting philanthropy and public funding, the UK would probably rank first. It's a huge market for impact investing, but not as we define it today. Nevertheless, even if it's a small market, it's a vibrant market. You can see the impressive growth rate of 132 in the last 2 years, and we believe it's an important part of the SRI toolkit with surely its own ecosystem, but one that can add a lot of value as well. So I think I've covered everything, and we might have a few minutes maybe for questions from the floor.
Yes, thank you, Francois. I think we have like 10 minutes left, so some questions have been coming in. First of all, there is a question about the retail demand in Europe, which is rather low. And do you have any explanations for this? And I would like to start to ask this question to you, Francois, and later on also to Simon.
Okay, thanks. I think it's quite a relevant question, in fact. It's low. Well, it's low in terms of market share first compared to the institutional market share, because the institutional SRI market is growing very fast, especially as a few large players are deploying SRI policies. So that's the first comment to relativize a little bit the figures. Now, it also depends on what you qualify as retail. And remember that we are talking here averages. In some markets, in fact, such as Switzerland or France or Belgium, the retail market is quite important. In fact, in France, it's about 30% of the SRI market. It's mainly driven by employee saving schemes where you do have to have, by law, some, let's call that impact investing offerings. It's also driven by the life insurance market, which is quite big in France. In Belgium, it's essentially driven by the structured product market. But there are opportunities to grow that retail market in Europe. One of the challenges, I think, lies into the distribution structure of mutual funds in Europe. And if I take the UK aside, the distribution of funds is mainly driven by bank branches in Europe. And I believe one of the challenges is that the sales process for SRI funds may not be very easy, or we have maybe as an industry made this very complex. SRI is all about gray zones, investment dilemmas. It requires a little bit of narrative and explanations. So all these things that you don't have the luxury of time when you sell such products in branch. That's why maybe it resonates better with the high net worth segment where the sales process is a little bit different. So in a nutshell, that's what I would say about the retail market in Europe. Simon, anything about Australia maybe?
Yeah, I think again it comes down to the dynamics of the particular market, and in Australia the dynamics that really drive this are our compulsory pension fund system over here, where when you first get your first job you're signed up to a pension fund, and from then on you get about 9% of your salary put into your pension in an ongoing basis. And as a result of the compulsory system, you see a very significant portion of Australians are entirely disengaged from their pensions, even though it is the second largest investment they will make in their entire lives after buying a house. So it's a strange phenomenon where people, it's very common that people don't know how much they've got in their pension fund nor where it's invested even. So there's a struggle there to get people back engaged and thinking about where their money is invested. I think one of the factors that is really driving an uptake in interest and driving consumers to start asking the questions as to where their money is invested is, in fact, we have some very strong NGO activity using social media in quite a savvy way at the moment, who are connecting their networks to start asking questions of their banks and their pension funds and their fund managers. And that has become a really significant element of getting people back engaged. And I think what they're aiming at is that those who have a natural inclination to more ethical or conscientious consumption patterns, they are driving to start asking these questions. And I think that is certainly in the banking sector, that's been really significant shift there, and we're starting to see that flow through to the investment sector. So for example, at last count, we have about 25 not-for-profit organisations, NGOs in the environment space, who currently have campaigns focused on the finance sector in Australia. So it's really driving a massive interest through their membership, that they probably represent over 1 million people, which is out of a population of 23, 24 million. It's a sizable proportion. So I think we're starting to see the very early stages of an awakening from the consumer side to say, well, actually, this stuff is important, and I'm going to start asking some questions. But yeah.
Thanks, François and Simon. François, after your comments that it might be tough on the sales side to explain what it really is about, all this sustainable and responsible investment, I know there are some initiatives on transparency, on perhaps classifying or labeling, or at least sharing information. Would that help to give more transparency, let's say, make it more easy for the retail? If you those initiatives, can you tell a bit about them, of those initiatives?
Good question, Giuseppe. Very sensitive topic. Yes, my personal conviction is that labeling can help. We have examples in other sectors, the food, the garment sector, where labeling can help. The question is, first, SRI is a relatively young industry, so it's a fast evolving industry. Practices are evolving. There is a lot of sophistication, at least in Europe, so a lot of strategies are combined. So there is inherent complexity in the market that could make labeling challenging. The second thing is you need to have legitimate and credible, of course, labeling. So how do you legitimate? Who is in charge of labeling? What's the methodology? Who decides on the methodology? These are important questions. But in principle, yes, labeling can be an important contributor, I think, to foster growth in the retail. I should add also that there were also a couple of surveys of the retail market in France, Italy, and maybe somewhere else, and these surveys show that there is also latent demand for SRI products. So it's just a matter of how do you materialize that? You know, what is the right product for this? I was talking recently to somebody in Belgium who was telling me, well, you know, structured products are fairly easy they're popular first, and they're fairly easy to understand. So if on top of it you say they are responsible product, that's a double whammy, which explains maybe the success of these products in Belgium.
I'd probably just add that that's, I think, a really important market intervention to unlocking the latent demand that we certainly have assessed in our market as well. A huge latent demand sitting there, and our polling would indicate that about 70% of Australians just expect that their retirement savings are managed responsibly and doing no harm. Most are shocked when they realise some of the holdings that they actually have in their pension funds, and we also found that the largest barrier to the uptake of SRI options is the lack of clear independent advice to help people navigate towards those options, which is why we've just spent 4 months refining our certification program, where we do certified products, we audit them, and then we're building a web tool to help people navigate towards them, because we see it as a massive way to unlock the market potential there.
Great. Well, it seems like a great initiative to clarify what it actually means to the retail market. Lydia, a question has come in for you. Could you comment about the state of the impact investments in Asia? You still with us, Lydia?
Yes. Can you hear me?
Yes, we can.
I think that's a great question. First of all, I would like to start with a bit of maybe definitional introduction. Impact investment means very different things to many different people. As we defined it in our review, we said that it's really an umbrella term for investment and lending to companies and entrepreneurs to generate a measurable social and/or environmental impact by solving either challenges or generating innovation. Many of the investors in the impact investment space, they actually come from a philanthropic background. So they maybe have more of an intention to focus only on the social impact or only on the environmental impact. But impact investment clearly takes the economic factor into account, because the investor will make the investment for a certain time and then exit the investment. So that is the definition that we used. There is certainly a very significant growth potential in Asia. At the moment, based on our research and on the discussions we are having, it's more situated in the family office sphere and in the high net worth individual space. So those are the, I would say, targets and the most interested parties in impact investment for the moment. Yes, I think one of the major challenges.
Okay, thank you, Lydia.
I just wanted to name one of the probably the challenges, that it's not that there is not enough interest, but it's more that the capacity and the awareness about impact investment as well as the products here in Asia are more limited. So that's something to keep in mind as well.
Thank you, Lydia. One more question came in for you, and that's about the speed of change. You mentioned it already. In some countries, ESG seems to be in a very nascent stage, with a focus more on CSR reporting by companies rather than on active ESG integration by investors. And this coupled with limited transparency in reporting, how fast or how slow do you think this whole sustainable and responsible investing will progress in Asia?
I think because we talk about such a diverse market, it's very, very difficult to make a general prediction. What we already see is that specific countries, for example, China, for example, Indonesia, that they are very progressive, and we can then expect ripple-on effects. So we've seen that one stock exchange, maybe let's look at Singapore, for example, they're very advanced in many different ways, and then Hong Kong looks at the same topics, and they're more encouraged because they see results and they see positive feedback. So I think as soon as we have some pioneers in the space, we will see much faster and much more development in the space. But it is true that given the different development stages the countries are in, and given the different also focus the national agendas have, it's very difficult to make a general progression, but we are positive with the growth we are seeing, that it will happen much faster than compared to, for example, Europe or the US. So we see that Asia is really leapfrogging and learning from what has been done in other parts of the world.
Great, thank you. I have two more questions. It's 10 o'clock, but we start a bit later, so I take till 10:05 perhaps. One question for you, Simon. You mentioned the 4 criteria for the, let's say, selection of the sustainable asset managers, and then you mentioned that only 11 of the 75 BRI signatories were selected at the end. I was wondering, what of those 4 gives the most potential, let's say, for improvement? So what are those 4 criteria? Public commitment, policy, transparency, and a systematic process. Do you think they lack behind?
Yeah, well, I think it tends to be a journey through which asset managers will go as they take on board practices of responsible investment and practices of ESG integration, and usually the first steps are to put in place some policies and some public commitments. And what really tended to differentiate those asset managers was their ability to demonstrate precisely how ESG factors were integrated into their core investment decision-making process. You know, what point are those ESG factors used through valuations, DCF models, etc. And some of the asset managers we researched, it was very clear the process by which in their overall investment process ESG factors were considered. Others, there was never a sense of clarity as to how it's used. And so I think that's what we're trying to get at, is precisely how are you using that information and how is that impacting upon the investment universe, influencing your investment decisions, etc. So I think it's those issues of systematic process, very importantly the systematic, i.e. every investment decision, in the same way that other ratios and financial data is influencing every investment decision, and also then that evidence of active ownership and stewardship. That's really a differentiating point. So beyond just merely saying we do engagement, it's about saying, well, are you reporting on your engagement? How many engagements did you have? What was the purpose of those engagements? Were they successful? And so really that's where we saw the leaders were really strong at reporting on that part of their active ownership strategies.
Thanks, Simon. That also sounds like good advice to those asset managers. Where are the easy gains? And last question is for you, Francois. I have several questions has come in about definitions and the methodology. Do those several reports across the globe use the same criteria? Examples are about ESG integration, where yours have really looked to, is it implicit, is it systematic? Do you use the same criteria there as other sustainable investment forums use? Perhaps you can comment on that.
I would say, you know, at the beginning, for those who are interested, at the beginning of the GSIA, your report, you will find a methodological and terminology section, and we, broadly speaking, all GSIA members use the same definitions. There might be some nuances, of course, for example, around impact investing or engagement and voting based on local practices, but by and large, the definitions are the same. I think what Simon said about integration echoes what I was saying as well, to some extent, for Europe, you know. Now, the way we collect the data can be a bit different that can differ here. So we have not done the in-depth analysis that RIA has done in Australia. You know, we are relying on self-reporting, at least at this stage, at Eurosif, given the scale of a market we have to cover and the resources we have. I hope that helps answering the question.
Absolutely, thank you very much. Well, it's 10 here in Utrecht in the Netherlands. I want to thank all our speakers, Simon O'Connor from RIA, Lydia Gouet from SRIA, and François Passon from Eurosif, and of course everybody who attended this webinar. As I said, those who are interested, at 5 o'clock Central European Time, we'll have another webinar also including the report of US SIP. So those who are interested, please join us then. And for the rest, I wish, depending on the time or place on Earth where you are, wish you a good day, a great evening, or a good night. Thank you very much.
Thanks.
Thank you.